Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and author of The Options Playbook. All right, we've had some rallies in the market recently. The consumer has really been the bright spot in the marketplace. We had Walmart announce earnings this morning along with Home Depot. Walmart had good news basically about inventories. They're waning. They're able to sell off whatever they have in their inventories, and that comes along with increased sales. Home Depot had fairly decent numbers also, not quite as good as Walmart, but that's kind of pulling the market up a little bit recently, not to mention the fact that we had decent CPI numbers. There are okay forecasts out there as far as inflation, and maybe we've peaked. That's what everybody has been hoping for. Everybody keeps saying it, and it just hasn't happened. So we finally got a clue that maybe it is happening, and that has sparked the markets, and they have been rallying. So a couple of other things that happened this week is Mr. Buffett and his company, Berkshire Hathaway, came out and made some purchases this week. One of them was in the semiconductor, TSM, Taiwan Semiconductor. So we're going to actually use that today. We're going to feed off of that a little bit today on our stock pick for this week. And as always, it's not meant to be a recommendation, but we're going to actually look at an ETF that tracks the semiconductor industry, SMH. Now, before we get too far along, though, I want to talk about what happened last week. We've been doing a little bit of let's jump into the rally. We don't want to really miss out in this market. We went all the way back to a couple of weeks ago. We talked about Caterpillar. Caterpillar had a good earnings report. Well, they did okay in their earnings, but one of the biggest things was that demand wasn't really waning. And that's what their comments were after their announcement. And since that time, their biggest concern has always been supply constraints. And we've gotten some news on that front. So far, supply constraints are getting looser nowadays. There's not a big pile up of ships just waiting to dock out in California. And we're seeing other shipping costs just in general start to come down. So that is also helping with the inflation numbers. We're finally seeing housing rolling over. Housing prices has dropped quite a bit, and because of all of these things, we got all the ducks in a row for a decent holiday buying season, and so we see the markets up. Right now, we see the S&P 500 index. I'm going to share my VIX watch list here. We have the S&P 500 index right now up about 1.5%. The Nasdaq up 2.5%. And that has probably a lot to do with the semiconductors and the pull up that they're getting from the investment from Berkshire Hathaway. And then we also see the Russell 2000 index, or the IWM, which is the ETF that tracks it. That's up 2.5%. All of this has brought the VIX down. VIX was trading right around 24, 25 before the CPI number. Oh, and by the way, we did have an election, so that's over. that unknown is gone by the wayside. Not a ton of people are talking about it, but with that said, that also has brought the VIX down. The VIX trading at 2350, down about 23 cents on the day. In this day and age, I'd say low volatility is really down around the 20% level. That's a different range than it used to be prior to the pandemic, but when we're seeing the VIX down around that level, it's just kind of hinting that people are feeling a little bit more comfortable about the markets, and we're seeing that come off going into September and October. I talked many times about the VIX just not increasing enough considering what was going on, not to mention in the U.S. markets, but globally across the world with food prices and obviously the conflict in Ukraine and between Ukraine and Russia. All these things have added, have started to wane a little bit. We're seeing Russia doing a little bit of a retreat, just like the markets were prior to September and October. And we're just looking at a decent setup for maybe a Santa Claus rally at the end of the year. So a lot of maybes in here. There's still any one-off black swan event could really hurt the market. And if that were to happen, it would more likely happen in Europe and with the geopolitical scenario that's going on. Okay, so let's look at last week's trade. And it was almost just a fear of missing out. Caterpillar, we went and bought an option outright, longer term option, deeper in the money, just saying that we wanted to own a piece of Caterpillar, but we're still nervous about the market. But we decided we wanted to do a longer term investment using options, buying an option that acts a lot like the stock. Stock goes up 1, our option contract had a delta that was fairly close to 80, meaning that our contract would go up about 80 cents for every $1 movement in the underlying stock. Very expensive option contract. And then this week, going into the CPI data and a lot of interesting data points last week, we decided that we're going to buy an out of the money SPY long call spread. So bullish on the market, but a little bit more nervous in that scenario, in that we're hoping that the numbers would be good and drive the market higher. So we were more worried about the risk of having capital on the sideline that you have maybe already sold and got out of the market. So let's buy in a way protection in case the numbers are good and we get a good run up in the market. And if we look at the chart in the SPY, that is exactly what happened. We're seeing that 200-day moving average. We had what's called a golden cross as far as the moving average is concerned. And we talked about it a little bit on last week's show, in that we see the 20-day moving average breaking through the 50-day moving average. And now we've ran almost all the way up to the 200-day moving average. And you notice that is an area of a little bit of resistance right there. We've already bumped up. We see what's happened a couple of times when we bumped up against the 200-day moving average in the SPX. This is actually the SPY, the ETF that we were trading options in, that we did our paper trade in last week. And so a little bit of nervousness right in that level, but a strong move up so far and trying to get our ducks in a row. You know, ideally what we'd like to see is the 20-day and the 50-day above the 200-day moving average. But right now, if we could just get the market to actually break out through that and stay sustained above that 200-day, that would be something to watch. That would be a good sign for the markets in general. All right. So the trade that we looked at, we're at 457, up 544 today in the SPY, and that's exactly what we sold. So we went out to the December 5th expiration. If we did anything that you could criticize in this trade, is we probably just went out a little bit too far. We went out to the December 5th expiration, 20 days away. Our target was 400. The market has gotten there, but it went there very quickly. And that's one of the things that we talked a lot about on a long call spread is, if you're buying one option contract and selling one option contract, the one that you bought wants the market to go up, The one that you sold wants the market to stay where it's at or go down. So they fight each other a little bit until they don't. And when don't they fight each other as much is closer to the expiration date. That option contract that you sold, you want that time decay to happen and you want it to start withering away. We got a little bit, we had a strong move up. We were 20 points wide, which kind of helped here. When we went out and did this trade, here's the trade that we looked at last week on paper. We bought the December 5th expiration 390 call and at the same time sold that same expiration 400 call. And we're right at 400 right now. The midpoint is about 660. Well, it's 667. We could fill somewhere close to that. We put this trade on for $3.60. That means that we've almost doubled on the trade. Little less than double, but up about 100, 90. We'll call it 90% on that investment for every one by one that we did. The maximum that I can trade for is 10 points, or the width between the spreads, or $10. So I don't mind if you would just get out of the trade. You paid $360 and you've got the potential for it to double. We've made a strong move up to the upside. The 200-day moving average has definitely provided a ceiling before in the SPX or the S&P 5 or the SPY in the index. So a little bit of headwinds coming up. So let's just look at trading out of it. So how would we exit this trade? We have the position on. This is what we were long. We just go over in the Ally Invest option chains in the right rail where we see buy to open. That is now going to be a sell to close. And where we see sell to open, that is now going to be a buy to close. And in this instance, $6.67 net credit to the account. So I'll click on that. We'll make it 667. And then send that order to the floor. We're always going to try to look for a midpoint fill. The SPY is a very, very liquid underlying. So I don't have any problems trying to enter it at the midpoint. Now, never a guarantee of a fill. But whenever we're doing spreads, we're always going to enter a limit order. Even if you're trying to sell it on the bid here, and the bid here is 655, I'm still going to put that limit in right at that 655. I would expect to fill very quickly in the SPY, but I'm always going to enter it at a net debit or a net credit to the account. In this instance, it's going to be a credit because we paid a debit to get in. We're going to receive a credit to sell it and close the position. Now, before I get into SMH, we're going to do something very similar. We're still, and I've talked a lot about this on the last couple of shows, is it's just really hard to try to find something to maybe be bullish on. And so we looked at a few of the different industries that we thought maybe in a downturn that we could be bullish on. And this week, we're gonna just kind of lean into Berkshire Hathaway and what they're doing this week and what the news has came out. They've really driven the markets up, and maybe it's made a little bit too much of a run. So we're going to be cautious with this, but we are going to do a trade in the SMH, which is an ETF that tracks the semiconductor industry. And before I do that, though, I just went through a lot on the SPY trade from last week, and I'll highlight that here in the actual options playbook. One second. There it is, long call spread. And that's what we did. If you have any questions on long call spreads, please put them in the chat box. We'll try to address them at the end of the show. Want to get ahead of the game. A couple people submitted some questions, and it took a couple of minutes for it to actually pan out before I could see them in the chat box. So if you have them, please go ahead and load up that chat box, and we'll try to address them on this trade or on the SMH trade too. Okay, so let's look at SMH this week. It's the VanEck ETF Semiconductor. Right now it's up already 4%. So it is up strong, up $9 on the day. Taiwan Semiconductor is up even more than that. But one of the biggest things about the semiconductor industry is there are a lot of stocks that have a lot of high valuations. We've looked at a few of them, and it's one of the industries that has been of interest because there's always going to be demand for semis. Part of the issues with the semiconductors is supply chain and the constraints of it and their ability to meet that demand. So the demand is there, a little bit like we were talking about with Caterpillar of a couple of weeks ago. So the valuations are just a little bit higher when we talk about the semiconductor stock. So instead of just trying to cherry pick one, like Berkshire Hathaway did with Taiwan Semiconductor, I'm going to just look at an ETF that's going to track that whole industry and, get rid of a little bit of that volatility from buying a one-off semiconductor stock. So that's the thought that's behind it. We're going to stick with the bull call spread. Okay, so I like to try to tie everything together because what stock play of the day is about when we're looking at an option strategy is trying to take the strategies inside the options playbook and apply them to certain conditions. We went deeper in the money on Caterpillar. Volatility was fairly low in the underlying. They had already announced earnings. Volatility had came off. And we bought a deeper in the money option contract because of the way our forecasts looked at and because of the conditions in the underlying stock, the option pricing conditions. We come back, we look at SPY. We've got the same kind of outlook, but now we're a little bit more nervous in SPY. So we actually went a little bit out of the money, hoping that the CPI numbers would be good and we'd get a decent run up in the underlying stock. And we didn't want to risk as much. So we did a bull call spread out of the money, almost as a protection for our cash, if you will. That's one way to look at that trade, but that was the concept that was behind it. So now we got some momentum in the semiconductors. I don't mind the concept of going further out in time and buying a bull call spread or a long call spread. And I'll highlight that right now, actually, in the options playbook. Let's just highlight that strategy. I don't mind that concept, applying everything that we talked about last week in SPY and doing it in the semiconductors. I definitely want to do a spread, mainly because there's a lot more volatility. Even the ETF that we're going to look at today, going out about 30 days in time, is trading at over a 40% implied volatility. So definitely a lot more volatility than a Caterpillar, the stock. So because of that, I want to do a spread. I want to buy an option contract and sell an option contract. That kind of mutes the fluctuations in implied volatility. You're selling an option contract that doesn't mind if implied volatility comes down and time decay happens, and you're buying an option contract that does not want implied volatility to come down and does not want time decay to happen. So they offset each other, and that's the concept of the long call spread. So this week, I'm just going to straddle the market. I'm going to buy a little bit deeper in the money. I'm going to sell a little bit out of the money. So basically, I'm saying I only want to play within the strikes. And by doing that, I can get something that's going to act a lot like the stock in between the strike prices. So by going a little bit deeper in the money and a little bit out, and we straddle it, we're going to go about equidistance. We're going to buy almost as much time premium. We'll get a lot of intrinsic value, but almost as much time premium as we're selling. That means our break even will be very close to where the stock break even would be if we bought it outright. So once again, there's no golden book of answers as far as option strategies are concerned. You want to look at the underlying that you're considering. And as always, this is not meant to be a recommendation. We're just trying to learn how to apply over the 40 different strategies that are inside of the options playbook to the current market conditions. All right, so let's get to the Ally Invest option chains. And here they are. So today we see it's up 4%, 227.76. So the straddle the market, we're going to go, I think in this instance, no, 1 second. Let me look to see if I can find where the trade is that I had. Okay, there it is. I was in the wrong chain. So we're going to go a little bit in the money. 227.80 is where we're at. So we're going down. We're going to buy the 225 and we're going to sell the 235. So we're going to go 10 points wide. And I'm trying to keep the cost at a minimum here. We're a little bit in the money by buying the 225 strike. I wouldn't mind doing the 220 and selling the 235 and literally just straddling the market as best as possible. But then it makes it fairly expensive. And I don't really like to look at too expensive trades here on the stock play of the day. Every once in a while, it might serve a purpose. So I'm actually going to go up to the 225 strike and I'm going to sell the 235 strike. So we're going to go 10 points wide and I'm going to basically risk $4, well, $5 to make $5. So if you want to get technical, $4.90 on a 10-point wide spread, hoping to make $5.10. That would be the maximum that we can make. So because of everything that I just mentioned when we were talking about the SPY, this is the reason why we're looking at this long call spread in SMH today. We're going a little bit more short. Well, I guess it's about the same as when we put the SPY on last week. We got the December 16th expiration. Last week we looked at a December 5th expiration. So we're fairly close as far as days to expiration. And we're going to give it a little bit of time to play out. And this will be the paper trade for this week. So let me put it in the right rail. And here's what we'd be looking to do. Buying to open one of the December 16th, 225 strike calls. At the same time, selling to open that same expiration, 235 strike calls. We're going to do it for a net debit of $4.90 to the account. That means that in this scenario, we are paying $490 plus commission. Don't forget that we're still paying commissions on these trades. And that would be our maximum risk. For every one-by-one spread that we do, we're trying to execute at a net debit of $4.90 or $490 plus commission. Our upside would be the width between the strikes, which is $10 minus the net debit paid, $4.90. So our max upside is $5.10 on this trade. Days to expiration looks like we have 31 days, so got a little bit of time to play out. If you are incorrect on your forecast and the stock doesn't go up, that time value will help you get out at less of a loss. If you are correct, like we were in the SPY last week, and it runs up too quickly, one of the downsides is that it doesn't reward you as quickly, right? So time frame is very important when you're doing long call spreads. And if I'm just buying a call outright, I'm just going to err to the side of buying too much time, because time decay is definitely a thing. As you get closer and closer to expiration, it accelerates. So I don't mind being a little bit longer, paying a little bit more just to get a lower rate of time decay when I'm buying an option outright. Totally different scenario when we're looking at buying a long call spread. All right, so if you have any questions, please put them in the chat box and I'll try to address them. I'm going to scroll down and we're going to look at the profit and loss calculator here inside the option chain. So let me get that all set up. And we'll just talk a little bit about the fact that we have some volatility. And what I'm trying to highlight here is that this is the Ally Invest profit and loss calculator. It's a theoretical calculator just saying that if vol were to stay the same, and using a pricing model to try to get a feel for how the spread might move as expiration approaches. Here's where the underlying stock is at. If we put this on, there's still 31 days remaining at expiration. If the stock skyrocketed all the way up to 235, well, if that happened, we're not going to get rewarded quite as quickly, right? And you see this, this is as of today, that's that colored line. The dotted line is at expiration. Now let's go and cut this all the way down to like 5 days remaining to expiration. Keep your eyes right here. And notice that moved up quite a bit. So because of that, that just kind of highlights that as expiration approaches, you want some time decay. You want implied volatility to come off a little bit. You want that option contract that you sold to trade as close to zero as possible, or basically get rid of all the time value in it. I don't mind if it has some intrinsic value if it goes in the money, but I want that time premium to erode. And if we go all the way down to close to expiration and we regraph it, now we're looking a lot like the dotted line or very close to that expiration date. But to start with, if we're correct and it instantly jumps up, well, we still have a profit. It's still a good thing, but you see how our profit is not as big as if it's closer to the expiration, but also our loss is not as big either. Right? So let's focus on this end and let's try going all the way down. We'll go to 5 days to expiration, and then we'll go all the way down to 0 days to expiration. And you see much difference. So Time will protect you in a long call spread if you're incorrect on your forecast, but it also will take away from your reward if you are correct sooner than later on your forecast. All right, so let's see if we have any questions here. Dev has more of a comment. Thanks for saying hello, saying I love these market reviews that you do at the beginning. Well, I appreciate that. A lot of times when we're just looking at this, though, we're just trying to get a setup to try to decide, every week we're trying to keep it interesting. We're not just going to come in and just buy long calls or just buy long puts every week. So we're always trying to come up with a here and now scenario that we can teach using options. It's more so about the teaching of the methods and the thought that goes into the options playbook and what strategy we're going to use each week. And so having a little bit of a setup in the market and understanding that this is what's going on in the marketplace and why we might be a little bit more bullish this week than we were last week. If you notice, if we go all the way back to the September and October, a lot of the strategies we were really bearish in the tech area. And a lot of that has to do with seasonality. It just is so odd that September and October just seem to be volatile months to the downside, more so to the upside, comparatively to the rest of the months on the calendar. And there's never really necessarily a rationale behind why there is. I'm sure there's been a lot of papers written on it, but it is what it is. That's simple. All right. So Wayne, welcome back, Wayne. Haven't seen you in a little bit. Hey, Brian, it's good to be back. Oh, there you go. What about a diagonal to shorten our time? A diagonal spread would mean that you are buying a longer term option and selling a shorter term option. That's okay, Wayne. The biggest thing about a diagonal, though, is that it adds a level of complexity. You're selling an option contract with a different expiration than the one that you're buying, and that isn't for the light at heart. It is tough to do those type of strategies. If you do, you want to make sure that if the stock hits the strike price of the short option contract, that you do something with that trade. You got to have a plan. You should always have a plan when you're trading options. But with that said, if you're doing diagonal, something with different expirations, you want to definitely have a plan and stick to the plan. Okay, this is from Mark. Appreciate your insight and knowledge. Great stuff. Appreciate that. I appreciate you too, Mark. That's awesome. Well, if you're liking what you're hearing, please smash that thumbs up and click subscribe, ring the bell, share with all the friends and family. It's always fun to, we want to drive some people to the site. Never a cost for listening to the stock play of the day. And I think that'll be it. Oh, got one last question under the bell. What price would you sell at if you were nervous about the trade, profit-wise? $2. Yeah, about $2. So if I'm paying $5, a lot of people on a long call spread will say if I lose about half the value. So $2 is not a bad spot. I never. Okay, so like last week, we paid $3.60 on our long call spread in the SPY. We had to move all the way up to 400, like literally on the call. The SPY hit our short strike of 400. We were up on that trade just over $3, about $3. I made quick math over here, about $3.12. Okay, so think about that, $3.12, and we already hit our short strike. I didn't make that entire $10. We had $10 in our trade. So I made $3. We sold it. We put it on for $3.60. If we sold it today, we got out at $6.72. So very rarely are you going to make the maximum on the upside. So on the downside, some people would like to protect and say, I never want to lose the maximum. And if you're getting out, Marcus, at around $2 or maybe $2.50, you can say, I paid $5 for it. I'm going to get out when I lose half of it. That's a solid plan. That's what I see a lot of option traders do. They want to let the winner run a little bit more, take the losses when they can on the downside, and try to save yourself on that position. SPY or SMH will be a very volatile underlying. So yeah, definitely want to keep an eye on those prices. And that's part of the reason, like I mentioned, I wouldn't mind going a little deeper in the money on the long option contract, but I didn't want to have that much exposure. I didn't want to have increased cost, which on a long spread, whatever you pay for it, long call spread, whatever you pay for it is your maximum risk. So I actually moved up a little bit on strike to try to keep it right around that $500 level, as opposed to be looking at a $700 or $800 trade. That simple. All right, everyone, that's it for this episode of the Stock Play of the Day. Next week for the holiday, we will not be around. So we're going to take next week off for the Thanksgiving holiday. A lot to give thanks for from the Stock Play of the Day. So click subscribe, ring the bell, and we'll see you in a couple weeks' time. Thanks for coming, everyone.